Turning to the economy now, and the new challenges facing the Federal Reserve as it meets today to decide whether to raise interest rates once again. The U.S. Central Bank walking a risky tightrope of sorts between the ongoing push to rein in inflation and the current turmoil in the banking industry. NBC's business reporter Brian Cheung joins us now to break it all down. So let's start there. Try to read the tea leaves for us here with the turmoil in the banking industry that we've seen over the last few weeks. Do we think that's going to affect the Fed's decision at all?
Yeah, absolutely. And, Craig Savannah, it's a really interesting situation here because prior to all the banking issues, it was really a one-track mind for the Federal Reserve, the steward of this economy, which was raise interest rates to make inflation go down. We've all been feeling the pinch at the store. But what complicates things is that one of the reasons for why Silicon Valley Bank failed, it's not the entire reason, but one of the dominoes to fall was higher interest rates. So if you're the Federal Reserve, you're stuck between this rock and a hard place of if you raise interest rates too fast, you risk breaking another bank. But if you don't raise interest rates fast enough, then you don't take care of inflation, which is the reason why a lot of Wall Street analysts say, okay, well, we're predicting that they'll go by the smallest increment that they could do in raising interest rates, which is a quarter point. That's the expectation this afternoon.
A quarter point. That's
they're looking for the Goldilocks just right.
Right,
just
yeah, threading the needle.
Yeah, but how about inflation? I mean, these rate hikes, this would be the 9th rate hike in a year if it happens, which is unprecedented. Are they working to tame inflation? Yeah,
well, I mean, look, this is the fastest that the Federal Reserve has ever moved to raise interest rates since the 1980s when we saw hyperinflation, right? So, and by the way, that's one of the reasons why the banks were not prepared. At least Silicon Valley Bank was not prepared. But inflation, as you mentioned, it got up to levels that we saw also not since the 1980s. 9.1% was the peak that we saw in the summer of last year. It has gone down a little bit at a yearly rate. Now it's somewhere closer to 6%. But economists say where we really want to be is somewhere closer to 2%. So from 9 to 6, okay, that's great, but it's not yet mission accomplished, which is why the Fed says, look, we have to continue to raise interest rates to try to deliberately take steam out of this hot economy. But again, that mission is not yet done, and it's coming at a time when there's some serious jitters in the banking.
And there's a lag time, too, between when they raise the interest rates and when the impact and inflation is felt.
It takes time to bleed through the economy.
It's not an easy job.
Not at all.
Brian, thank you.
Hey, thanks for watching. Don't miss the Today Show every weekday at 11 a.m. Eastern, 8 Pacific on our streaming channel, Today All Day. To watch, head to today.com/allday or click the link right here.